All right, let's talk about a number you probably hear every single day, a number that moves trillions of dollars and can literally shape the economy. We are going deep, deep, deep on market indices like the S&P 500 to figure out what they're really telling us. You know exactly what I'm talking about, right? You flip on the TV and some anchor says, the Dow is up 200 points, or the S&P just hit a new record. It sounds important. But what market? And how on earth do they boil down the chaos of millions of trades into one single number? Well, that's the big mystery we're going to solve together.
So here's our game plan. We're going to break it down into 5 parts. First, we'll decode that number you see on the news. Then, we get into the secret recipe, how these things are actually built. We'll talk about why an index isn't set in stone. Then, we'll cover why we even need them in the first place. And finally, we'll look at how things have just completely exploded in the last decade.
To really get what that number on your screen means today, we actually have to go way back. Back to a time before any of it existed, when a couple of newspaper guys had a pretty revolutionary idea.
Think about it. For the longest time, you could see the price of one stock, but you had no clue how the overall market was doing. That all changed in 1884. Charles Dow and Edward Jones, you might have heard of them, they bundled together 11 stocks, mostly railroads, into a single average. It was so simple, but it was a total game changer. A few years later, in 1896, they launched the now famous Dow Jones Industrial Average. And from those 12 stocks, we now have thousands and thousands of indices, tracking literally everything under the sun.
So at its heart, what even is a market index? Well, it's just a basket of stocks, or bonds, or whatever, that are handpicked to represent one little slice of the market. The S&P 500 tracks 500 of the biggest US companies. The NASDAQ 100, that's for the big tech names. Each one is like a carefully curated snapshot of that specific market's health at any given moment.
Okay, now listen up, because this part is absolutely crucial. When the news says the S&P was up 1%, they are almost always talking about its price return. That's just the stock prices going up and down. But as an investor, you get paid dividends, right? A total return index actually includes those dividends and pretends to reinvest them. And let me tell you, over time that compounding makes a huge difference. The total return, that's what's actually happening in your investment account.
So, we know an index is a basket of stocks. Simple enough. But how do you decide how much of each stock to put in the basket? Now this is the secret sauce. The weighting method, let's call it the recipe, is what makes every index behave so differently. It's everything.
The OG method, the one that Dow Jones still uses, is the simplest one. It's called price weighting. You basically just add up the stock prices. And as you can see here, a stock that costs $50 has way more influence than a stock that costs $4. It doesn't matter how big the company is, just the price tag on the stock. So in this case, stock A is the one driving the bus.
And for this little time period, our price-weighted index gave us a return of 3.45%. Got it? Okay, lock that number in your brain. Now let's see what happens when we use the exact same stocks, but just change the recipe.
All right, next up, the equal weighted index. Now the logic here is totally different. We just pretend to put the exact same amount of money into every single stock. It doesn't matter if it's a $50 stock or a $4 stock, they all start with a 20% weight. This basically gives the little guys in the index an equal voice.
And would you look at that? The return just jumped to over 10%. That is a massive difference, and all we did was change the weighting. So what does that tell us? It means that during this period, the smaller stocks in our group must have absolutely crushed it.
And finally, we've got the most common method used today, market cap weighting. This is how the S&P 500 does it. The weight is based on the total value of the whole company. It's stock price times all of its shares. So the biggest companies get the biggest say, which kind of makes sense, right? They have the biggest economic footprint. And notice here, it's stock B, not the one with the highest price, that's now the dominant force in the group.
And the return for our market cap weighted index is, drumroll please, just under 1.5%. Wow, a totally different result yet again.
And this is the aha moment, seeing them all side by side. We use the exact same 5 stocks over the exact same time. But just by changing the recipe, the weighting, we got 3 completely different answers about what the market did. So if you take one thing away from this, it's this. When someone gives you an index return, the most important question you can ask is, okay, but how is it weighted?
So that brings us to our next big idea. You can't just create these indices and then walk away.
Nope. They're more like living things that have to be managed and updated all the time just to stay relevant.
See, this process of swapping stocks in and out of an index, it's called reconstitution. Companies get bought out, they go bankrupt, or maybe they just don't fit the rules anymore. And because so much money automatically follows these indices, just the rumor that a stock might get added can kick off an insane buying frenzy.
And this is just a perfect example of that. Back in 2009, traders started whispering that this tiny company, Uranium Energy Corp., was going to get added to the Russell 2000 index. In just the 3 months before it was officially announced, the stock price skyrocketed by nearly 400%. Why? Because all the funds that track that index had to go out and buy it. It just goes to show you the incredible real-world power these decisions have.
So we know how they're built, we know how they're managed, but why do we even care so much? Well, it's because these indices have become the fundamental plumbing of the entire modern financial system. They're everywhere. Really, they do 5 main jobs. 1, they're a quick gut check for market sentiment. 2, they're used as stand-ins for different asset classes when you're building a portfolio. 3, and this is a big one, they're the yardstick that your 401k manager gets judged against. 4, they're the actual blueprints for creating ETFs and index funds that millions of us own. And 5, they help us measure a stock's risk. It's beta, which tells you how jumpy it is compared to the rest of the market.
Now, the fantastic CFA Institute text we used as a source for this was from 2011, and a lot has changed in the world of indexing since then. I mean, a lot. So let's hit the fast forward button and see what the world looks like today, in 2025.
Check this out. It's a perfect example of how an index tells a story about the economy. Back in 2011, the Wilshire 5000, which is supposed to be the total market index, had over 6,000 stocks in it. Today, it's closer to 3,500. The index itself is shrinking because the number of public companies is shrinking. They're merging or just staying private for way longer.
And there are 3 huge trends shaping the future right now. First, the unstoppable tidal wave of passive investing. Trillions of dollars now just automatically copy these indices. Second, the demand for something called smart beta, which are indices built on things like a company's revenue or its dividends, not just its size. And third, the ESG revolution. A whole new universe of indices is being born to help people invest based on a company's environmental and social impact.
In the end, it all comes back to this one simple, powerful idea from our source material. An index is a tool. And like any tool, if you want to use it right, you have to understand how it's built and how it works. It all comes down to knowing the recipe.
And that leaves us with one last pretty heavy question. We've seen that the choices made by these index committees, which stocks get in, how they're weighted, can move markets and steer billions of dollars. That's an immense amount of power for a small, unelected group of people. So as we move into the future, maybe the most important question isn't just how the recipe is made, but who gets to decide what goes in it.